Cryptocurrency investors and Web3 CFOs, are you just now updating your accounting for 2024? If so, it may be too late and you may be facing tax issues because you did not update your accounting by the January 1st deadline set by the IRS. This is something that I've seen go widely overlooked industry wide, and there's been a ton of misinformation on this topic. So I want to go over today what this issue is and how you can deal with it if you're not currently in compliance. So let's get right into it. What am I talking about? So back in 2024, towards the end of June, the IRS released Revenue Procedure 2024-28. This revenue procedure required anyone that's done their cryptocurrency accounting on a universal basis to change to an account basis. I don't want to get into all the weeds on this revenue procedure because I've done separate videos on it, so I encourage you to check those videos out. But the big thing to understand for purposes of this video is you needed to make that shift from universal to account-based by January 1st. What I've seen is that a lot of people have not taken these steps for various reasons. Some were just completely unaware that this revenue procedure was released last year, either because they didn't see the information themselves, their CPA didn't notify them. For whatever reason, they were unaware of this and they missed the safe harbor deadline. There's another group of people I'm seeing where they have been given inaccurate guidance, either by their CPA or just the media or tax professionals that they're following online, who told them that they may not have to worry about this revenue procedure. Now, while that may be true for a small minority, most people that have been doing their calculations accurately on a universal basis do need to comply with this. What I saw was towards the end of December, we saw a Notice 2025-7 get released. And what this did was provide an extension on the timeline that taxpayers have to leave standing orders with their brokers, which is one of the components and requirements with the Revenue Procedure 2024-28 for people that are using Spec ID. So when this notice came out, there was tons of headlines that was picked up across mainstream media and industry media as well within our industry. And they were basically saying tax reporting's deferred, revenue procedures deferred, don't worry about it. I even saw a lot of posts from other CPAs and other tax professionals running with this misinformation. So if you are one of these people that saw headlines like this or saw this tax notice, what you need to understand is that this did not extend the timeline for you to comply with Revenue Procedure 2024-28. All Notice 2025-7 did is extend the timeline for you to provide standing orders to brokers. So you still need to be in compliance with this. So now, you may be listening to this and realizing I missed the safe harbor deadline. What are the tax implications to this? What the safe harbor deadline protects you from is penalties and interest and recalculations if you undergo an audit related to your portfolio or to your business. So this does come with an increased tax and overall audit risk if you're not in compliance with this. So, if you've missed this deadline, it is crucial for you to work with a crypto CPA that understands this, like me and my team at Camuso CPA, as soon as possible to get you into compliance. And that can look differently for, each individual or each business that we're working with, depending where you're at up to this point. We may look at recalculating everything on an account by account basis if you don't have a very clean and accurate basis that's been calculated in prior years. And if you're not extending back that many years, this may be a good fit. We may have to, if you have reported correctly, we may have to still recalculate it and amend returns if you want to be fully in compliance, or we'll have to do the global allocations as of a certain date so we can just simply get into compliance moving forward with the third-party reporting and aligning our reporting with the requirements for account-based reporting. Now, if you take that second round, you're still risking the interest and penalties because you missed the safe harbor. So, there's no perfect solution for this, but my approach is taking a look at what accounting have you done so far? What is the quality and accuracy of that? And what tax reporting have you done so far? And then we need to make a game plan on how we're going to get your accounting caught up, get your tax filings compliant, and ensure that you're on track to be doing account-based accounting moving forward. Now, another very important thing to understand is, I've seen tons of taxpayers for years use HIFO and use LIFO and other beneficial accounting methodologies on a universal basis. If you did not document your standing orders in your books and records by January 1st, you're going to have to default your calculations moving forward to FIFO. So this is going to be potentially, like, if you're on a different accounting method, this can lead to unexpected tax implications. And it's another reason why you want to get this up to date, and you want to get a handle on your cost basis as soon as possible. So when you're disposing of these assets in 2025 and beyond, you know what the tax implications are going to be. There's going to be people that are now defaulted to FIFO because they've missed this safe harbor and they haven't complied with these requirements. And maybe they'll let more time pass. They'll be transacting in the market, and eventually, they're going to realize they have to be on FIFO once they talk to a CPA, like me at Camuso CPA. But before then, they may have been thinking they were on HIFO and have a completely different idea on what their anticipated tax liability is going to be. So this is going to be, a big issue, especially if you have not been using FIFO in the past, because there may be some unexpected tax liabilities from that perspective. So, the big key here, it's like your basis needs to get updated as soon as possible to bring you in, not only to bring you into compliance with this revenue procedure, but just so you understand when you're making moves in this market, what are the overall tax implications going to be related to this. And that's going to be driven by what accounting method you have to use. And if you haven't selected spec ID and documented your standing orders appropriately, you're going to be basically stuck defaulting to FIFO. Now, if you continue on a universal basis, that is also not advised, because it's just not an acceptable way of doing the accounting as of 2025. So if you undergo an audit, there's going to be recalculations and interest and penalties, in addition to the increased tax liabilities that come from those recalculations. And in addition to that, we're going to start seeing 1099 DAs go out this year in 2025 and continue into the future. That's all going to be reported on an account by account basis. If that reporting starts to get misaligned with your taxpayer reporting, you can have matching issues related to that. And that's when you're going to start seeing tax notices and these compliance challenges. And this tax controversy is going to start to arise, and you'll probably find a tax notice in your mailbox. So it is very important that we don't have these broker discrepancies going forward, and we're aligning our reporting with the third party reporting. And how do we do that? We have to get you in alignment with this account by account based reporting. So it's crucial that we get this accurate. Now, one of the other things I'll point out is that we've been getting tons of people up to date during the end of last year, to comply with this. We've helped out tons of people, and that's been great. But one thing that I find is that most people don't have accurate basis calculations. And you picture someone that's been trading from 2016 to 2024. What I'm seeing is these people are coming to me, and they may have done their calculations on a universal basis and filed on a universal basis, but their cumulative cost basis calculations are inaccurate. And in those scenarios, what we have to do is we have to start from the beginning, get your basis updated through all the tax years so we can get down to an accurate 2024 to then do your allocations appropriately. Another approach we could take is just starting from the beginning again with an account by account based approach. This, to a large degree, this type of decision is going to be driven by what did you originally account for, what did you originally report, and how are we going to approach this going forward from a tax amendment standpoint. So, overall, a big bottleneck that I see people run into is their cumulative cost basis calculations are inaccurate. So even when they become aware of this change from universal to account based, they're not in a position to make the shift until they spend a significant amount of time and effort getting their accounting up to date. So, the tax consequences of this revenue procedure for the people that have either disregarded it or overlooked it are going to be a tax issue for years to come, in my opinion. And if you're out there right now and you haven't complied with this revenue procedure, or this is the first that you're hearing about it, I suggest that you reach out to me and my team today. We can sit down and we can have a conversation on what does your historical accounting look like? What do your historical tax filings look like? And what is the best way to get your crypto accounting into compliance in light of these new requirements? So if that sounds like it's something that you need, you can contact me and my team today at CamusoCPA.com, and I'd be more than happy to speak with you. Until next time, I'm Patrick Camuso, signing off.